afternoon, everyone. Welcome to the Inflation Report press conference. On my right is Ben.
At its meeting yesterday, the MPC agreed an exceptional package of measures comprising, first, a 25 basis point reduction in bank rate to 0.25%, a new term funding scheme to reinforce the pass-through of that cut in bank rate to the borrowing rates actually faced by households and businesses, a new program of private sector asset purchases with up to £10 billion of UK corporate bonds, and a £60 billion expansion of gilt purchases. We took these steps because the economic outlook has changed markedly, with the largest revision to our GDP forecast since the MPC was formed almost 2 decades ago. Early indicators are consistent with the risks that the MPC had identified before the vote. And we now face a trade-off between the degree of support we give to the economy on the one hand and how fast we return inflation sustainably to target on the other.
Zero, but I noted the use of the word currently.
Yeah. The MPC expects several factors to weigh on investment in the near term and on employment and consumer spending over time. These include a protracted period of heightened uncertainty, weaker activity in residential and commercial real estate, and a higher cost of capital for UK-focused firms. Some of these effects are beginning to manifest in surveys of investment intentions, business activity, and the housing market. These indicators have all fallen sharply, in most cases to levels last seen in the wake of the financial crisis, and in some cases to all-time lows. The MPC has been conservative in its interpretation of these data, producing a forecast stronger than historical relationships would have implied. Nonetheless, we expect aggregate demand to grow only a little over the next few quarters before picking up to rates below those projected in May.
To this from people who supported Brexit and maybe even from some former MPC members.
The extent to which this lower path for aggregate demand is likely to be accompanied by a lower path for aggregate supply is a key determinant of the inflation outlook. The weakness in demand will itself weigh on supply as a period of low investment restrains growth in the capital stock and productivity. There could also be more direct implications for supply from the decision to leave the EU. The UK's trading relationships are likely to change, but precisely how will be unclear for some time. If companies are uncertain about the future impact of this on their businesses, they could delay decisions about building capacity or entering new markets. In addition, in anticipation of the UK's new trading arrangements, a period of resource reallocation could be necessary as some sectors of the economy expand and others contract.
Just how extraordinary was the problem with which you were presented by the Brexit vote?
As a result of these factors, the MPC expects supply growth to remain well below past average rates throughout the forecast period. The combination of these demand and supply factors means that cumulative GDP growth is expected to be 2.5% lower by the end of the forecast period than was the case in May. On balance, even after stimulus, a margin of spare capacity is expected to open up and the unemployment rate expected to rise from its current level of 4.9% to around 5.5% over the next 2 years. The fall in sterling will push up on import price and consumer prices, notably over the next 3 years. Indeed, despite the much weaker outlook for activity, CPI inflation in 2 years' time is projected to be higher than expected in May, reaching 2.4% at both the 2- and 3-year points of our forecast.
Infrastructure bonds for public investment. Would you have any objection to using the asset purchase facility?
All of the elements in this package have scope to be increased. The MPC can lower bank rate, increase the size of the TFS, and expand the scale or variety of assets held in the asset purchase facility. Indeed, if the incoming data prove broadly consistent with the August inflation report forecast, a majority of MPC members would anticipate a further cut in bank rate to its effective lower bound at one of the MPC's forthcoming meetings during the course of this year.
On Radio 2 yesterday, and a saver, a lady doing a question and answer session actually for ordinary people.
The Bank of England continues to stand ready to take whatever action is needed to achieve its objectives for monetary and financial stability as the UK adjusts to new realities and moves forward to seize new opportunities outside the European Union.
David.
David Smith, Sunday Times. Governor, one of the